with a 1 1/3 percentage point gain. Mukul Kochhar, head of equities at Investec Capital Services, is joining us on the show. Mukul, it's been a while since you've joined us on the show, so thank you very much for that.
Look forward, yeah. Thank you very much. Look forward to the interaction.
So first, just tell us, what have you made of the correction that we've seen over the last couple of months and this quick, swift recovery for the last couple of days? Your thoughts on the market setup?
Sure. The correction was set up because, a little bit overvaluation was there in the mid-cap side. And then, China suddenly came into favor and massive outflows took place since October in India. And then money went back to the US. So flows combined with expensive valuations were the trigger, and that is what the correction has been about. What we've been telling people, though, on the other hand, is that fundamentally India is just looking, nothing has really changed. India is still looking good. On the other hand, we may have been slightly better than last year. For example, FY25 growth across indices is better. Growth in earnings has improved as the year has progressed. The lack of or miss in momentum that was there post the central government slowdown after elections, that has also picked up. Most importantly, our current account is actually looking better as the year has progressed, as services exports have come in their own. Today, as we look at the figures, services exports practically, totally offset the trading goods deficit that we have. That is the basic fundamental aspect of India that we highlight to clients, that when it comes to INR, which is the rupee and the currency, we're on solid footing. And that is going to be the trigger for this turnaround. And that has turned out to be the trigger for this turnaround. Because when the INR becomes, gets on sound footing and INR starts appreciating, FII flows will turn, which was the trigger for the correction last year.
But do you think the FI flows have turned? We've had 3 days of FI buying last week. Was it just a flash in the pan? What are your conversations with foreign investors like?
Yeah, I actually really don't think it's a flash in the pan, because if you think about it, just the fact that FI flows became neutral, because remember, it's just been positive, as you said, for the last 3 days. But the market rally has continued now for maybe 7, 8, 9 trading days. So the rally started without FI participation. Actually, the rally started as FIs were already selling. Now, if the FIs turn positive, we could actually get into a self-fulfilling cycle at a time when valuations have become more supportive. In fact, we did our promoter or the annual founder conference 2 weeks back, and a lot of the foreign investors that were there at the conference were net short India. And I would say not net short or underweight compared to their historical weight in India. And this, I think, if the currency also starts appreciating and is an incremental benefit to them, it'll be tough for them to sit this one out.
Right. Mukul, you just briefly mentioned about the conference that you held in the week gone by. Incrementally, what was the kind of commentary that you received from managements? And do you feel that we are now at an earnings inflection, especially given the low base of FY24? Do you think FY26 can be a much better year in terms of earnings?
Yeah. So what is very interesting is that if you're in a bear market, and our conference, honestly, in the first week of March was squarely in the middle of the bear market. Promoter, founder commentary or management commentary is as negative as investor commentary, and that's what we saw. Having said that, we even that time were thinking that this will not take time to turn. So, for instance, I'll just give you an example. A lot of concern around the capex cycle, but when we look at the numbers, we could already see that central government's spending has already turned in the month of December, January. And by the way, the slowdown that is there in the central government expenditure also, if you look deeper, for example, I just take the example of roads. Yeah, it's not because the government doesn't have money or intend to spend. It's because land acquisition has actually sort of made implementation that much more difficult. So the government is saying, hey, let us focus on completing things rather than announcing new things. So nothing fundamentally wrong there. And, capex, concern around capex. However, on the other hand, on the positive side, we saw a lot of positive commentary from manufacturing companies, from pharma companies around new molecules like semaglutide that are supposed to come. So, company specific, but broadly negative. Finally, on earnings, when we look at earnings for the 3 quarters gone by, two things we can conclude: that FY25 earnings as they stand today are very achievable, as in consensus earnings will likely be beat for FY25. The second thing is looking at again the exit quarter, which is the third quarter of FY25. We don't think there's downside to FY26 estimates as well. So post this correction, sell side analysts have taken their estimates down, and we think earnings, let's say double-digit earnings in FY26 and FY25 are very, very doable.
Double digit even in FY25, or you just said FY26 double digit earnings?
Both FY25 and 26.
Got that. What about headwinds in the form of the global headlines, the global trade friction, the resurgence of China, China's technology upending everything that we knew about technology and its greatness? So relatively India looks good, but in the face of, say, US economy slowing down, what if it goes into a recession? There is talk of stagflation. How much of a risk is the global macro backdrop to your mind?
That's a very, very good question. And actually, we get asked that a lot. The simple answer to that is today our trade linkage to the world is negligible. Yeah. So if we are 3% of the global economy, our trade linkage or manufacturing trade, I'm not talking about services. Services we do quite well. And that is something because of demographics, because of the value India offers, is already on a strong footing. When it comes to goods trade, we are roughly 3%, or manufacturing, we are roughly 3%. Yeah, manufacturing in India. Let's just say manufacturing in India is roughly 3% of global manufacturing, and that is what is the concern on global slowdown. That is a concern when it comes to tariff. And honestly, when you look at that, look at the commentary of the manufacturing companies, look at the clear sort of direction from the developed world to create alternatives to China, I think we will get down the global slowdown quite okay. Yeah, because on one hand, our services exports offer cost benefits as well as an answer to the demographic challenges in the developed world. On the other hand, our goods exports provide an answer to companies or countries trying to de-link their supply chains from China. So I think both can work very well, even in a slowing global backdrop. So I'm not too concerned, honestly, about global slowdown. I'm actually looking more into how we get through the trade negotiations that are ongoing with US and Europe, and that to me looks like a huge opportunity than a risk.
Mukul, are you particularly worried about the impending retaliatory tariffs that are likely to come into effect from April 2nd? And very quickly, your key overweight as well as underweight sectors.
Yeah, so April 2nd is certainly going to be newsworthy. Yeah, so but I think one should look beyond that. Look at the signals that are coming out of the top members of the Trump government. All of them talk about, let's sit together, let's work out an agreement that works in both our favors. They don't, and they at the same time also say we don't like the status quo because we are big importers of goods and we want to change that. Honestly, if you take out the rhetoric, it's a very reasonable stance to start with. Yeah, and so far India also has taken a negotiation approach rather than playing it out in the media, out in the open, and that is the right thing to do. And that I think is sort of finding favor, at least with the current US administration. Let's see how it goes. I'm still hopeful that it will turn out well for India. We are, while we are a large economy, we are number 9 or number 10 in terms of US trade deficit. US is also not threatened by India geopolitically as it is with China. So I think it's in both our countries' interest to deepen trade linkages, and that may actually come out in the second half of the year. Even if April 2nd, is, as I said, noteworthy in terms of some negatives there. So I'm still very, very constructive on how this plays out through the year, and it will play out in 2025 itself. That's one.
Sorry, go ahead.
And the second question was around sectors we favor. So sectors we favor is both a combination of the valuation that they stand at, and their competitive position of companies within the sector. So financials, of course, I mean, it's sort of semi-consensus today, but we believe that the larger banks, and we've been saying this for the last 6-7 months as well, have improved their competitive positioning over the last 10-12 years. And, despite that, they're trading at a discount versus their historical average. And why have they improved their positioning? It's more expensive regulatorily. It's more expensive in terms of technology. They have better cost of funding. Finally, people forget that the larger banks have better products. I mean, very few small banks have a credit card, which is one of the most profitable retail product that a bank puts out. So barriers to entry in the large banks are higher. There's only one success you can make out in a challenger bank, which is Kotak over the last 2 decades. That tells you the industry has very high barriers to entry. And at a time when these stocks are trading at all-time lows, or historical sort of recent historical lows, we are constructive over them. The larger PSU banks as well as private banks. We also like pharmaceutical sector for the kind of cash flows these companies are generating. The fact that pharma capex is come off quite substantially. Even as these companies make low return on invested capital today, we expect this ROIC to improve. And we're not worried as much about the US tariff threat, because you can see that all we export to the US is $8.5 billion. And if you look at the company internals, none of this supply is profit making. So Indian pharma is where they make their profits. US is where and when I say profit, it has to make cost of capital. So if more restrictions are put around imports, I genuinely think that the response would be, let's reevaluate our presence in that market. So there's some sectors we like, and otherwise stock specific like infra, oil and gas, all these sectors are also looking good at this point.
Great conversation. Thank you. Well-rounded one. Thank you, Mukul, for joining on. Look forward to more conversation. Need to get into a break, but as we do that,